Let's talk taxes. Nobody likes paying more than they have to. That's where depreciation comes in. It's a powerful tool to lower your tax bill. Depreciation lets you recover the cost of business assets over time. This means you get to deduct a portion of the cost each year. This lowers your taxable income, which means you pay less in taxes. It's like magic, but it's legal. Think of depreciation as a reward for investing in your business. You work hard for your money. You deserve every tax break you can get. Depreciation is here to help. Depreciation isn't just for big corporations, it's essential for small businesses and startups. It can even help you buy new equipment or expand your operations. In the long run, depreciation can make a big difference to your bottom line. So, let's dive in and see how you can make it work for you. Depreciation might sound complicated, but it's really not. Imagine you buy a brand new copy machine for your business for $5,000. You're not going to use that copier for just 1 year, right? Of course not. You'll likely use it for several years. Depreciation recognizes that this copier's value decreases over time as it's used. It's like wear and tear, but for tax purposes. Instead of deducting the entire $5,000 cost in the first year, you spread out the deductions over the copier's useful life. This is usually determined by the IRS. Let's say the IRS says your copier has a useful life of 5 years. With depreciation, you can deduct a portion of the $5,000 each year for 5 years. This way, you're matching the cost of the copier with the income it helps you generate over its useful life. Keep in mind that depreciation only applies to certain assets. These are things your business owns that have a limited lifespan and lose value over time. Think computers, vehicles, machinery, and even office furniture. Land, on the other hand, generally doesn't depreciate. Now here's where it gets a little trickier. Choosing the right depreciation method. The IRS gives you options: straight line, accelerated, or Section 179. Let's break them down. Straight line depreciation is the simplest method. You take the cost of the asset, subtract its estimated salvage value, what you think you can sell it for at the end of its useful life, and divide that amount by the asset's useful life. This gives you an equal deduction each year. Accelerated depreciation methods like the double declining balance method allow you to deduct more in the early years of an asset's life. This can be a big advantage for businesses that want to recover their costs quickly. Section 179 is like a supercharger for depreciation. It lets you deduct the entire cost of qualifying equipment and software up to a certain limit in the first year you place it in service. This can be a game changer for small businesses looking for a big tax break. Which method is best for you? It depends on your specific circumstances, the type of asset, and your business goals. Talking to a tax professional can help you make the right choice. Section 4. Claiming depreciation, navigating the IRS maze with Form 4562. Okay, so you understand depreciation. Now, how do you actually claim it on your taxes? That's where IRS Form 4562 comes into play. Don't worry, it's not as scary as it sounds. Form 4562 is where you report information about your depreciable assets. You'll need to know the type of asset, the date you placed it in service, its cost, the depreciation method you're using, and its useful life. The form will guide you through the calculations. Remember, accuracy is key when it comes to taxes. Make sure you keep detailed records of your assets, including purchase dates, costs, and any improvements you make. This will make your life much easier come tax time. If you're using tax software, it will likely walk you through the process of claiming depreciation. But if you're not comfortable dealing with tax forms, don't hesitate to seek help from a tax professional. Section 5. Timing is everything, maximizing deductions with half-year and mid-quarter conventions. Here's a little secret. When you buy an asset can affect your depreciation deductions. The IRS uses conventions to determine how much depreciation you can claim in the first and last years of an asset's life. The most common convention is the half-year convention. This means you can generally deduct half of the depreciation for the year, even if you place the asset in service late in the year. For example, if you buy that copier in October, you still get to take half a year's worth of depreciation. There's also the mid-quarter convention. This applies if you buy a significant amount of your depreciable assets in the last quarter of the year. The IRS wants to make sure you're not trying to manipulate your deductions. Understanding these conventions is important for maximizing your depreciation deductions. Again, A tax professional can help you navigate these rules and ensure you're taking advantage of all available deductions. Section 6. Depreciation in action, a real-world example with office furniture. Let's see how depreciation works with a real-world example. You decide to spruce up your office and buy new furniture for $10,000. You place this furniture in service on January 15th. The IRS says office furniture has a useful life of 7 years. You decide to use the Modified Accelerated Cost Recovery System, or MACRS, which is the most common accelerated depreciation method. Under MACRS, office furniture falls under a 5-year depreciation schedule, even though its useful life is 7 years. This means you can deduct a larger portion of the cost in the early years. In the first year, you can deduct 20% of the cost, or $2,000. This reduces your taxable income by $2,000. In the second year, you can deduct 32% of the cost, or $3,200. And so on. As you can see, depreciation can significantly reduce your tax liability over the life of the asset. This example shows how MACRS lets you recover your costs more quickly than straight-line depreciation. Section 7. Depreciation, a powerful tool for small businesses and beyond. Depreciation is a powerful tool for any business that owns depreciable assets. But it's especially beneficial for small businesses and startups. First, it can free up cash flow. Instead of deducting the entire cost of an asset up front, you spread out the deductions over time. This leaves you with more cash on hand to invest back into your business. Second, it can make your business more attractive to investors. By reducing your tax liability, depreciation can boost your profitability. This makes your business look more appealing to potential investors or lenders. Third, it can help you grow your business. The tax savings from depreciation can give you the financial breathing room to expand your operations, hire new employees, or invest in new equipment. Depreciation is not a one-size-fits-all strategy. It's essential to carefully consider your options and choose the method that aligns with your business goals. Remember, knowledge is power when it comes to taxes. Understanding depreciation can save you money and help your business thrive.